Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss inflation and its impact on your investments and financial goals. Inflation affects all of us in different ways. Sometimes it hits suddenly like an earthquake, and other times it erodes purchasing power gradually over many years. Today, we're seeing both dynamics at play, making it crucial for investors to understand how to position their portfolios for various scenarios. Let's start by looking at how inflation has eroded purchasing power over the past century. This chart shows that what cost $1 100 years ago now costs $18. That's the dramatic effect of compounding inflation over time. You can also see that inflation accelerated in the 1970s and again more recently. Now, you might think that zero inflation or even deflation where prices fall would be helpful. But modern economic theory tells us that a low but positive inflation rate, usually around 2%, actually creates the best balance for individuals and the broader economy. This moderate level gives central banks room to implement monetary policy and helps prevent deflationary spirals where consumers delay purchasing while they're expecting lower prices in the future. However, this challenge for savers is that even at the 3% annual inflation rate, the cost of goods doubles roughly every 24 years. This means that $100,000 in today's purchasing power would require $200,000 in 2 decades, right within the span of an average retirement period. So, what's happening with inflation today? Recent reports show that inflation continues to be stickier than many would like. The latest producer price index jumped 0.9% in a single month, the largest increase since June of 2022. This matters because increases in wholesale prices often show up in consumer prices with a lag of several months. We're seeing this play out as companies that initially absorbed costs from tariffs may now be passing on higher prices to consumers. The consumer price index shows prices rose 2.7% over the past year, or 3.1% when excluding food and energy. Much of this increase came from rising housing costs. Although inflation is stickier than expected, it's also not at the double-digit levels experienced in 2021 and 2022. Still, it's important to hold a portfolio that can withstand both sudden and gradual inflation. This chart shows us that the average level of interest earned on cash hasn't kept up with inflation over time. In fact, short-term interest rates have been declining, making the situation even more challenging. Meanwhile, history shows that both stocks and bonds have outpaced inflation over long periods. Stocks can be volatile during periods of inflation, as we saw in 2022, which is why maintaining a balance of asset classes that can withstand both inflation and volatility is so important. Ultimately, it's important for long-term investors to resist the urge to make dramatic portfolio changes based on individual data points. While it's crucial to ensure your portfolio is positioned for different scenarios, overreacting to short-term data often leads to decisions that are counterproductive. Depending upon your personal goals, holding an appropriate portfolio that can generate both income and growth remains the best way to achieve financial success. We hope you found these insights helpful. If you would like to learn more about how inflation might affect your specific financial situation or discuss your portfolio positioning, please don't hesitate to reach out. We look forward to speaking with you.